Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5. I'm your host, and today we're examining a pure price action expert advisor called Wyckoff Spring Reversal. This strategy uses no indicators at all. Instead, it reads raw market structure, framing a trading range, and then hunting for failed breakouts, the classic Wyckoff Spring and Upthrust. By the end of this video, you'll understand exactly how it defines a range, how it spots a liquidity sweep, and how it places its stops and targets. Let's dive in. And remember, everything here is educational content only. Let's start with the big picture. Wyckoff Spring Reversal is a reversal strategy built entirely on price action. There are no moving averages, no oscillators, and no lagging indicators anywhere in its logic. Instead, it leans on a century-old idea from Richard Wyckoff, who studied how large operators accumulate and distribute positions inside trading ranges. The strategy works on any symbol and any time frame you attach it to, from major currency pairs like the euro against the US dollar to gold or stock indices. Its job is simple to describe but powerful in practice. First, it frames a trading range by scanning a recent window of completed bars and recording the highest high and the lowest low. That range becomes the battlefield, the area where buyers and sellers are fighting it out. Then it waits for a very specific kind of trap. When price briefly pushes below the range low, triggering stop-loss orders and tempting breakout sellers, but then snaps back inside the range before the bar closes, that failed breakdown is called a spring. It signals that selling pressure was absorbed, and the strategy prepares to go long. The mirror image, where price pokes above the range high and then closes back inside, is called an upthrust, and it prepares the strategy to go short. Because it only acts on these failed sweeps, the strategy is naturally selective. It does not chase trends or trade every single bar. That makes it best suited to patient traders who appreciate structure-based setups and who want to study how liquidity and stop hunts can drive reversals. As always, everything here is for educational purposes only. We are studying how the code behaves historically, not predicting what any market will do next. Now let's walk through the mechanics step by step. On every tick, the strategy first checks whether a brand new bar has just completed. It only acts once per closed bar, and it always evaluates the bar that just finished, never the one still forming. This avoids any look-ahead bias. It also checks that there are no open positions, because this strategy holds just one trade at a time. Next, it builds the trading range. It looks back over a window of bars sitting behind the signal bar, by default 20 of them, and records the highest high and the lowest low across that window. The difference between those two values is the range height, and almost every other calculation is scaled to that height. This keeps the strategy adaptive, whether the market is quiet or volatile. From the height, the strategy derives 3 thresholds. The minimum penetration is how far price must poke beyond the edge to count as a genuine sweep. The reentry distance is how far back inside the range the bar must close to prove the breakout failed. And the stop buffer is a little extra room placed beyond the wick. Now the strategy detects the patterns. For a spring, 3 things must all be true. The signal bar's low must dip below the range low by at least the minimum penetration. Its close must finish back inside the range by at least the reentry distance. And the bar must close higher than it opened, showing that buyers stepped in. When all 3 line up, the expert advisor signals a long entry at the ask price. The upthrust is the exact mirror. The high must exceed the range high by the penetration amount. The close must fall back inside the range by the reentry distance, and the bar must close lower than it opened. That combination triggers a short entry at the bid. Risk management is fully mechanical. For a long, the stop loss sits just below the spring's low, beyond the wick where the idea would be proven wrong. The take profit is then set at a fixed reward multiple of that measured risk, 2 times the risk by default. Shorts mirror this exactly, with the stop above the wick and the target below. Once the order is sent, the trade simply runs to its stop or its target, and the strategy waits patiently for the next setup. Here's the heart of the code as you'd see it in MetaTrader. At the top are the input parameters, the dials you can tune. RangeLookback sets how many bars frame the trading range. A larger number captures a wider, slower range. MinPenetrationFrac controls how deep the sweep must poke beyond the edge, expressed as a fraction of the range height. ReentryFrac sets how far back inside the close must recover to confirm the failure. Stop buffer frac adds breathing room beyond the wick for the stop. Reward ratio is your target as a multiple of risk, and lots is the fixed trade size. Below the inputs is the signal logic. First, the code computes height, the distance between the range high and the range low. It then turns the three fractions into actual price distances: the minimum penetration, the reentry, and the stop buffer, each one the fraction multiplied by that height. Now look at the spring test. It's a single true or false value built from three conditions joined together. The signal low must be less than or equal to the range low minus the minimum penetration. That's the sweep. The signal close must be greater than or equal to the range low plus the reentry distance. That's the snapback inside. And the close must be greater than the open, a bullish bar. Only when all three are true does spring become true. The upthrust test is the mirror image, comparing the signal high against the range high and requiring a bearish close. When a spring fires, the entry is taken at the ask, the stop is placed at the signal low minus the buffer. The risk is the gap between them, and the take profit is that risk multiplied by the reward ratio, added above the entry. Clean, mechanical, and fully transparent. Let's watch the strategy trade on this illustration. The two horizontal lines mark the boundaries of the trading range. The upper line is the range high, the lower line is the range low, both drawn from the recent look-back window. For the first several candles, price simply oscillates between them, building the range. Then watch the candle that drops sharply below the lower line. Its long lower wick spikes beneath the range low, sweeping the stop orders resting there. But notice how it closes back up inside the range as a strong bullish bar. That's a textbook spring. The strategy signals a long entry, and the stop loss is tucked just below that wick, the exact point where the idea would be invalidated. From there, price rotates upward, candle after candle, until it reaches the take profit, set at twice the measured risk. The first trade is complete. Now the range has shifted higher as the market moved, and you can see the boundary line step up to follow it. Price drifts back toward the new upper line, and then, on this candle, thrusts sharply above it. The long upper wick pierces the range high, sweeping the buy-side liquidity above, but once again price is rejected, and the candle closes back inside the range as a bearish bar. That's an upthrust. The strategy signals a short entry, places its stop loss just above the wick, and targets a take profit twice the size of that risk below. Price rolls over and slides down to hit the target. Notice that in both cases the entry came from a failed move, not a successful breakout. That single idea, fading the sweep that traps everyone else, is the entire engine of this strategy. And again, this is a clean illustration for educational purposes only. And that wraps up our deep dive into the Wyckoff Spring Reversal Expert Advisor. We covered how it frames a trading range, how it detects springs and upthrusts as failed liquidity sweeps, how the code turns those patterns into entries, and how it manages risk with stops beyond the wick and targets set at a multiple of risk. Remember, everything in this video is educational content only and is not financial advice. If you found this breakdown helpful, please give it a like, subscribe for more MetaTrader 5 strategy analyses, and drop a comment telling me which strategy you'd like me to examine next. You can find more at www.algobot.live. Thanks for watching, and I'll see you in the next one. Past performance does not guarantee future results. Trade responsibly.